If you're still trading time for money in an AI economy, you're not just behind, you're being replaced. Welcome to AI Market Mint.
Turn AI into income. Turn knowledge into freedom. Your digital HQ for smart wealth creation.
Look, if you are not front-running the capital rotation from mega-cap tech into small caps right now, you are practically volunteering to leave money on the table. I mean, the weekly charts are screaming for a reallocation.
Yeah. Oh.
But anyone paying attention to the macroeconomic indicators should be timing this shift aggressively.
See? You are falling into the exact trap we warn people about every single day.
How so?
That instinct you have right now, that absolute need to actively maneuver to, time the sector rotation and outsmart the trends, that is just analysis paralysis masking itself as strategy.
I strongly disagree.
Look, high intelligence is actually a massive liability in modern wealth creation. Smart people overthink themselves into poverty, while average people automate their way to wealth.
Wait, I have to push back hard there. We live in the absolute most data-abundant era in human history. You have institutional-grade macroeconomic indicators, global liquidity metrics, real-time order flow data, and it's all streaming directly to your phone.
Right.
If you have the processing power in your own brain to parse that data, why on earth wouldn't you leverage it? I mean, if you're writing a neural network, you need complex mathematics. Building multi-generational wealth shouldn't be any different.
It should be completely different because the stock market is not a physics puzzle.
It's a system, though.
It is not a closed mechanical system with predictable laws that just, magically reward pure intellect. It is a biological system.
Illogical.
Yes. It is driven by mass human psychology, fear, greed, institutional manipulation. When highly intelligent people look at the market, they possess this fatal psychological flaw.
Which is?
Ego. Plain and simple. They simply refuse to accept that a rudimentary, boring strategy can mathematically obliterate their highly sophisticated, custom-built models.
So what, they want their portfolio to reflect their IQ?
Exactly. That is exactly it. If you are listening to this right now and you spent your entire weekend reading dense financial reports just to find some tiny edge, ask yourself, are you actually trying to make money? Or are you just trying to prove you are the smartest person in the room?
You see this everywhere in the tech industry, honestly.
Oh, constantly.
You have software engineers, data scientists. They look at a basic S&P 500 chart, and their brain just completely rejects it as too primitive.
Right. It's not stimulating enough for them.
Exactly. They assume there has to be a hidden variable they can exploit. But the terrifying part is it's not just an isolated personality quirk. Society meticulously engineered this exact failure condition right into your brain.
It is a totally systemic trap. We have constructed an entire global economy that worships cognitive effort over simple execution.
Yep.
From the very day you enter the education system, you are conditioned to believe that compensation is tied directly to the difficulty of your labor.
The hardest calculus equation gets the highest grade.
Exactly. The most complex engineering problem secures the highest salary.
So the system hardwires you to equate struggle and complexity with success. And then you graduate, you take that capital into the financial markets. And that exact same mindset completely incinerates your net worth.
Because the market does not care how many hours you spent building a discounted cash flow model.
It really doesn't. It only respects the reality of corporate earnings and systemic liquidity.
And the entire financial services industry preys on that exact conditioning.
Oh, absolutely do.
Wall Street operates on this highly profitable illusion that investing is some dark art, right? That it's far too complicated for an average person to handle.
Because if they told the truth, they'd go bankrupt.
Right. If the major banks admitted that buying a low-cost, automated total market index fund is the mathematically optimal strategy, their entire business model evaporates overnight.
You cannot charge a 2% management fee for a boring automated index.
You just can't. So they manufacture complexity.
They invent actively managed mutual funds, structured notes, collateralized debt obligations.
Esoteric derivative strategies.
Exactly. They wrap basic financial assets in layers of impenetrable jargon, purely to make highly educated professionals feel like they are unlocking exclusive elite knowledge.
And doctors, lawyers, engineers, they are the prime targets for this.
Because they're used to being the smartest people in their respective fields.
Yeah, so they naturally gravitate toward advisors who speak to them in these dense, complex terms. They equate the thickness of the prospectus with the safety of the investment.
It is a massive intellectual blind spot. I mean, the history of finance is literally just a repeating loop of geniuses blowing up spectacular amounts of capital because they believed their complex models were infallible.
Just look at the collapse of long-term capital management in the late 90s.
That is the ultimate cautionary tale right there. You had a hedge fund run by actual Nobel Prize-winning economists.
Right. John Merriweather, Myron Skoll.
The absolute brightest mathematical minds on the planet, writing these pristine pricing models for global bond arbitrage.
Wait, Ollie, arbitrage sounds technical. What does that actually mean for a normal person?
Simple. It just means buying something cheap in one place and instantly selling it for a higher price somewhere else to make a risk-free profit. Imagine it like buying a rare sneaker at a garage sale for $10 and immediately selling it on eBay for $200.
Perfect. So these Nobel laureates were executing that exact strategy, but with global government bonds.
Right.
They found tiny, microscopic price discrepancies between bonds that historically moved together.
But because the profit margins on those discrepancies were so small, they used massive leverage.
Yeah, borrowing astronomical sums of money to amplify their returns. And their mathematical models assured them this was essentially risk-free.
But they mistook mathematical elegance for messy market reality. Their models relied entirely on historical correlation.
And then a massive systemic shock hit.
The Russian government defaulted on its sovereign debt.
Investors panicked.
Total global flight to liquidity. They sold the illiquid bonds and piled into the safe liquid ones.
So instead of the bond prices converging like those pristine equations predicted, the prices violently diverged.
The model deemed a Russian default statistically impossible. And because they were leveraged 25 to 1, the entire fund collapsed.
It nearly took down the global financial system with it.
The smartest guys in the room were completely obliterated by basic, irrational market panic.
The terrifying difference is, when a retail investor's complex strategy implodes today, the Federal Reserve doesn't step in to bail them out.
No, they just lose their life savings.
Yet they keep trying.
Yeah.
Because the psychological conditioning is just too strong. We're talking about an inverted Dunning-Kruger effect here.
Explain that.
Well, usually that effect describes incompetent people overestimating their skills, right?
Right.
But here, we have brilliant people acting financially reckless because they value the intellectual stimulation of trading more than the actual compounding of their wealth.
Let's map this out clearly so people can see the trap. Let's look at two incredibly distinct paths. First, you have Steve.
Okay, let's talk about Steve.
Steve is a senior machine learning engineer at a massive tech firm, pulling in $250,000 a year. His entire identity is tied to his ability to solve complex, multi-layered logical problems.
And on the other end of the spectrum, you have Rahul.
Right.
Rahul owns a mid-sized commercial landscaping business. He barely passed college algebra.
His daily cognitive load is totally different.
Yeah, it consists of managing landscaping crews, repairing broken industrial mowers, bidding on office park contracts.
So Steve decides it is time to build wealth. He looks at his tech salary, assumes his high IQ will easily translate to Wall Street, and just rejects basic index funds entirely.
He thinks they're for average people.
Exactly. He wants to extract alpha. So he spends 15 hours a week, after a long day of work, building a custom algorithmic trading bot.
Of course he does.
He hooks it up to Exchange APIs, he writes Python scripts to scrape social media for sentiment analysis, and he executes this high-frequency strategy, trading highly volatile tech microcap.
He is absolutely redlining his central nervous system.
Oh, completely. He monitors the portfolio on his second monitor during Zoom meetings.
He's tweaking the algorithm late at night, adjusting stop-loss parameters, optimizing entry points.
The mental bandwidth he is burning is just astronomical. He is perpetually stressed and emotionally tethered to the market's daily noise.
Now look at Rahul. Rahul does not know what a stop-loss is.
He doesn't care either.
He does not know how to connect to an Exchange API. He simply takes 20% of his commercial landscaping profits every single month and automatically routes it into a total stock market ETF.
Set it and forget it.
Exactly.
Yeah.
He spends exactly 0 hours a week thinking about the stock market. All of his excess mental energy goes right back into expanding his physical business and, spending time with his family.
Let's fast forward a bit. Steve's algorithmic bot has had some spectacular weeks. He feels like a titan of industry.
But he has also eaten brutal, stomach-churning drawdowns.
Oh, huge ones. He's constantly intervening, stopping, and starting the compounding process manually. But listen, this isn't just about psychological burnout. We have to look at the brutal mathematical drag of complexity.
A friction.
Yes, Taxes, technical friction, and opportunity cost. Let's run a strict comparison over a 10-year timeline, assuming they both start with exactly $100,000.
I'll even give Steve the ultimate benefit of the doubt here. Let's assume his complex bot actually works and he generates a gross return of 15% annually.
That is phenomenal.
It is. He is definitively beating the historical market average. And Rahul just holds his boring index fund, generating a historically standard gross return of 10% annually.
On paper, Steve wins easily. He is generating 50% more raw performance. But, and this is crucial, gross return is a vanity metric for amateurs.
You only get to spend your net return.
Exactly. Because Steve is actively trading, his gains are legally classified as short-term capital gains.
Wait, Ollie. Short-term capital gains sounds technical. What does that actually mean for a normal person?
Simple. It just means the government takes a massive penalty cut of your profits if you sell an investment before holding it for a full year. Imagine it like a bakery where the health inspector takes a third of your cakes if you sell them on the same day you baked them.
Right, so depending on his income bracket, Steve is instantly losing at least 35% of his trading profits directly to the IRS every single year.
Minimum.
His brilliant 15% return immediately collapses to roughly 9.7% after taxes.
His entire mathematical edge is completely wiped out by the tax code alone.
And we haven't even touched the friction yet.
The market is not a frictionless vacuum. Steve pays for API data feeds, server hosting, and most importantly, the bid-ask spread.
The invisible tax.
Right. Every time he trades, market makers see the order flow and clip a fraction of a penny. Over thousands of trades, that spread acts like a parasite on his capital.
So let's conservatively estimate that friction costs him another 1% annually.
His net return is now 8.7%.
It gets worse, though. You have to factor in the most expensive variable of all: uncompensated labor.
Steve's time.
Yes. Steve is spending 15 hours a week managing this complex system. That is 780 hours a year.
That's a part-time job.
If Steve values his free time at just $100 an hour, he is bleeding $78,000 a year in invisible labor costs.
He essentially hired himself for a high-stress second job that yields a negative net return against the benchmark.
Now run Rahul's math. He gets a 10% gross return.
Because he never sells a single share to rebalance or trade, he triggers absolutely zero short-term capital gains taxes.
His money compounds entirely tax-deferred.
The expense ratio on his index fund is 0.03%, which is mathematically negligible.
His trading fees are zero. His time spent is zero.
Rahul is netting a pure 10% compound annual growth rate.
So project that over 10 years. Steve's $100,000 growing at a net 8.7% turns into roughly $230,000.
Not terrible until you factor in the thousands of hours of life he burned.
Right. And Rahul's $100,000 growing quietly at 10% turns into nearly $260,000.
The commercial landscaper obliterates the senior machine learning engineer by $30,000.
And he did it while sleeping.
The math is just undeniable. There are no shortcuts. There's only capital, yield, and time. When you introduce unnecessary variables, taxes, friction, manual intervention, you just dilute the output.
Steve completely confused activity with achievement.
That's the core issue. In his corporate career, sitting still and doing nothing gets you fired. But in capital allocation, disciplined inactivity is exactly what makes you wealthy.
And listen, Steve's mathematical drag is brutal today, but what terrifies me is that the underlying landscape is actively shifting beneath his feet right now.
The AI factor.
Yes. The consequences of overcomplicating your wealth strategy are scaling exponentially because of artificial intelligence.
This is the real existential threat to the retail trader. Historically, a deeply analytical person like Steve might have had a slight edge over the average retail crowd.
Maybe a decade ago.
Not anymore. AI is completely democratizing complex data analysis. Institutional deep learning models can process and cross-reference an entire decade of SEC filings in 3 seconds.
3 seconds.
If your investment thesis relies on outsmarting the market through complex analysis, your edge is dead. You are taking a pocket calculator to a quantum computing fight.
Exactly. And explain how these institutional AI models actually hunt retail traders. It's not just that they process data faster, right? They actively exploit the complexity that retail traders introduce.
Oh, it's ruthless. It's called latency arbitrage and liquidity hunting. Retail traders like Steve use consumer-grade internet to connect to exchanges.
from their home offices.
Right. The institutional algorithms, though, are physically co-located inside the exchange servers in New Jersey. They operate in microseconds.
So they see everything first.
Exactly. When Steve's algorithm spots a trend and sends a buy order, the institutional AI detects that order flow in transit, buys the shares milliseconds before Steve can, and sells them to him a micropenny higher,
It's just skimming his capital.
constantly. Furthermore, machine learning models analyze retail trading patterns and map out exactly where amateur traders place their stop losses.
They know his breaking point.
They do. The institutional AI will intentionally drive the price down just enough to trigger Steve's stop loss, buy his shares at a massive discount, and immediately ride the price back up.
So Steve's custom bot is totally obsolete.
Dead on arrival.
In 5 years, his predictive models will be completely front-run by institutional supercomputers. His 15 hours a week becomes literally worthless.
His net worth will stagnate, and the psychological toll of watching people he considers less intelligent surpass him will just breed deep, bitter resentment.
Now look at Rahul. Rahul does not care about latency arbitrage.
He doesn't even know what it is.
He doesn't care what proprietary large language models Wall Street is deploying. Because he owns the broad index, he inherently owns the very tech companies that are successfully integrating and monopolizing that AI.
That's the beauty of it.
As those companies become vastly more profitable through AI-driven efficiency, their valuations explode. Rahul captures every single dollar of that upside natively.
He leverages the geniuses without ever stepping into the arena to compete against them.
That is the ultimate secret of the wealthy. They don't try to be the smartest person in the room. They buy the room, let the geniuses fight over the margins, and collect the rent on the entire building.
So to avoid Steve's fate, you have to ruthlessly surrender your ego.
You have to.
Look in the mirror and accept that your high IQ is a phenomenal shovel for digging capital out of your career or your business. But it is an absolute hazard when it comes to managing the actual hole you put that capital into.
This requires a fundamental pivot in how you view wealth creation. Stop viewing investing as an intellectual decathlon or some, puzzle to be solved.
It is an infrastructure project.
Yes, you are building a permanent plumbing system for your cash flow. Once those pipes are laid, you don't dig up the yard every week to see how the water is moving.
You drone the pipes.
Exactly. You channel your immense intellectual energy into increasing your income, get that promotion, scale your side business, but keep the actual investment mechanics completely brainless.
You need an actionable framework that actively, physically prevents you from intervening. Extreme, ruthless automation. You construct a portfolio based on strict target allocations, say 80% in a broad market index and 20% in a growth ETF.
Wait, Ollie, target allocation sounds technical. What does that actually mean for a normal person?
Simple. It just means dividing your money into specific percentage slices of a pie. Imagine it like deciding your diet will always be 80% vegetables and 20% protein, and never allowing yourself to change the recipe even if you crave sugar.
That unyielding discipline is where actual wealth is forged. But human willpower fails.
Always.
To maintain that discipline, you must structurally sever your emotional connection to the transaction. This is exactly why we use and recommend M1 Finance for this exact infrastructure.
It is engineered specifically to prevent the IQ trap.
Right. People fail because they trust their own discipline in highly emotional market environments. M1 strips that away entirely.
It forces you to think exclusively in terms of those permanent pies and percentages, completely insulating you from the noise of individual stock charts.
I build your portfolio pie exactly once.
You set your automatic deposit schedule once.
From that moment on, the platform handles all the execution.
When your cash hits the account, the system automatically distributes it to maintain your exact target allocations.
So if one slice of your pie shrinks because, say, a sector took a hit, the platform automatically routes your new deposits to buy more of it, bringing the pie back into balance.
It systematically forces you to buy low and sell high without you ever having to look at a chart, read a headline, or trigger a manual trade.
It eliminates the friction costs, the API fees, the emotional drag. It turns wealth creation into cold, automated mathematics.
We've put the official verified links in the pinned comment below. Don't go searching randomly and get scammed. Use the ones we've checked.
It takes 10 minutes to build the infrastructure, and it will save you 10 years of wasted life. It makes you wonder if AI eventually automates both the complex institutional trading and the simple index funds, what becomes the next true scarcity in wealth creation?
That's a great question.
Maybe the final frontier isn't where you allocate your capital, but where you allocate your attention.
Stop trying to prove how smart you are to a market that simply does not care. Automate your discipline, protect your time, and let the machines do the heavy lifting. Don't let the future leave you behind. Start earning.